Welcome to Breaking News to Trading Moves.
Glad to be here.
Today, our focus is on a pretty direct policy announcement about imported goods.
That's right. And we're seeing the ripples already, especially across the home goods and furniture sectors.
Yeah, exactly. We've looked at the material that's come out, and we want to figure out, who really gains from this and who's facing some new hurdles.
It creates distinct winners and losers almost immediately.
So the headline event, just to set the stage, is the White House announcing these new tariffs. They're targeting very specific types of imported furniture.
And the market reaction was swift.
It really was. Companies that depend heavily on those particular imports, their shares dipped.
While on the other hand, companies doing more manufacturing domestically, they generally saw a bit of a boost.
So the financial world is already trying to sort this out based on how these companies operate, where their supply chains are rooted.
Precisely. And for you, the listener, our goal today is to go beyond just that headline reaction.
Right.
We want to map out the specifics. What are these tariffs exactly? Why do they put pressure on certain ways of doing business?
And name the companies mentioned in the material, the ones flagged as potential winners, and those, in a tougher spot.
Exactly. We want to clarify the mechanism, how this trade policy translates almost directly into a competitive advantage or disadvantage, really depending on their existing supply chains.
Okay, let's get into it then. Section 1. The policy itself and the market context.
Sounds good.
First, we need to be really clear about the policy details, the duties themselves, because the percentages matter a lot here, don't they?
They absolutely do. The material points to two main categories getting hit, and the numbers are, they're quite high.
Okay, what's the first one?
First up, a 50% tariff. That's 50, on imported kitchen cabinets and vanities.
50%. Wow, that's a huge jump in cost right out of the gate for anyone importing those.
It is. And the second category is imported upholstered furniture. That gets hit with a 30% levy.
30%. Still very substantial. And when do these actually take effect?
October 1st. That's the effective date.
Okay, October 1st. So that's not a lot of lead time, is it? We're talking less than 2 quarters for companies to adjust, maybe even fundamentally change how they source and price things.
Exactly. That date means right now, companies are likely executing contingency plans. They might be scrambling.
Scrambling how?
Well, trying to accelerate inventory they already ordered, maybe delaying future orders, or even trying to quickly rework their sourcing map, though that's hard to do fast.
Right, and to really grasp what 50% or 30% means, we need to understand the market these companies operate in.
Absolutely. You have to remember, the U.S. furniture retail sector, in many parts of it, runs on pretty thin margins.
And it's heavily reliant on global supply chains, right? That's key here.
Very much so. When you talk about where most furniture imports come from, you're looking primarily at Asia.
Like China and Vietnam?
China, Vietnam, yes, those are huge. But Mexico is also a significant player. These places have become massive manufacturing hubs.
For everything, or specific things.
Pretty much everything. Finished case goods, tables, dressers, complex upholstery frames, cabinet components. They offer a scale and efficiency that's just, difficult to replicate quickly here in North America.
Okay, so the tariffs hit. October 1st arrives. What does that do to a company's cost structure, step by step?
The immediate thing is a jump, often a dramatic one, in what's called the landed cost.
Landed cost. Break that down for us.
Sure. Landed cost is basically everything it costs to get that product from the factory floor overseas onto the shelf or into the warehouse here in the U.S.
So manufacturing costs.
Right. Manufacturing, international shipping, insurance, and critically, any customs duties and taxes. That's where these tariffs hit.
And they hit the cost, not the retail price people see.
Exactly. A 50% or 30% duty isn't applied to the final sticker price. It's applied to the value of the goods, essentially their cost as they cross the border.
Okay. Can you give us an example, maybe with that upholstered sofa?
Yeah, let's do a quick hypothetical. Say an importer buys a sofa from a factory in Vietnam for, let's say, $400.
Okay.
And maybe shipping and insurance costs another $100. So before the tariff, the landed cost is $500.
Got it. $500 cost.
Now, layer on that new 30% duty for upholstered furniture. That duty is calculated on the $400 factory cost, so it's $120.
Ah, okay.
Suddenly, the new landed cost jumps from $500 to $620. That's a 24% increase in the importer's cost before they've even marked it up for retail.
24% increase in cost, just like that. That sounds painful.
It is. And it leads to two really tough scenarios for these importers. First, margin compression.
big time.
Meaning their profits get squeezed.
Severely. If a retailer was aiming for, say, a 40% gross margin on that $500 sofa, and they try to just eat that extra $120 cost, their margin plummets.
And if their actual net profit margin after all other expenses was only like 5% to begin with?
Then absorbing even half of that tariff could wipe out their profitability on that item completely. It's brutal.
So that's option one, eat the cost, destroy the profit. What's option two?
Option two is passing it on. They faced a necessity of pretty substantial price increases for the consumer just to try and get back to their previous profit levels.
But furniture, especially certain types, is pretty price sensitive, right?
Highly price elastic, especially for more commodity types items. So raising prices significantly isn't an easy choice either. Demand could just dry up.
Okay, so neither choice is good. Lower margins or potentially lower sales due to higher prices.
Precisely.
And this need to potentially raise prices, that's what starts rearranging the competitive landscape we're seeing.
Exactly.
We have to talk about the consumer effect here. Because that's where the rubber meets the road, isn't it? How do shoppers react?
That's the crux of it. When importers are forced to push prices up significantly, it directly impacts demand, especially, as you said, among those price-sensitive shoppers in the entry-level and mid-market areas.
So if that $500 sofa, which maybe retailed for $800 before, suddenly needs to be priced at, say, $950 or $1,000 to cover the tariff and maintain margin.
Right. The consumers who were budgeting strictly for that lower price point, they're forced to look elsewhere. They might just not buy, or they might look for alternatives.
And where does that demand go? This seems critical.
It tends to gravitate towards brands that are, well, insulated from these specific tariffs.
Meaning companies that make their stuff mostly in North America.
Primarily, yes.
Yeah.
Those building in the U.S., Canada, or Mexico aren't paying these new duties. Or demand might shift to brands that have such strong loyalty or unique products that their customers are just willing to pay more. They have pricing power.
So this is how the domestic players get an advantage. It's not just that their costs are stable, but that their competitors' costs are rising.
That's the key mechanism. That flight to domestic or tariff-immune alternatives is what hands the immediate advantage to the North American manufacturers.
They aren't just competing on price anymore.
No, they're suddenly operating under this protective pricing shield, you could say, created by the policy itself. The consumer reaction, shifting demand away from the newly expensive imports, is what translates the tariff burden into potential market share gains for domestic rivals.
Okay, that sets the stage really well. Let's move into section 2 then. The predicted winners. Who benefits from this?
All right.
Now that we've got the mechanism, these higher landed costs for imports really hurting certain business models, let's look at the companies structurally set up to actually benefit. The material seems pretty clear. It favors domestic manufacturers.
Absolutely. The first group that stands out is the domestic upholstery manufacturers.
Okay.
These companies, maybe because of strategic decisions made years ago to keep production in North America, are suddenly in a pretty good position.
Why specifically them?
It's straightforward, really. Since they produce mainly in the U.S., or maybe Mexico or Canada, which often fall under different trade rules, they aren't subject to that 30% import duty on upholstered goods coming from, say, Asia.
So their costs stay relatively stable.
Exactly. While their competitors who rely on imports are facing that sudden cost jump we talked about. This creates what analysts often call a widening price umbrella.
Price umbrella. Explain that concept a bit more. It sounds important.
It's all about relative pricing power. Let's take a recliner as an example.
All right.
Before the tariff, maybe a domestically made recliner retailed for $1,200. Its production cost might be $650.
Right.
A comparable imported recliner, maybe just as good in quality for many consumers, might have retailed for $1,050 because its landed cost was only $550.
So the domestic one was at a price disadvantage, $150 more.
Right. But now, slap that 30% duty on the imported one. Let's say it adds $100, $150 to the importer's cost. Now, that importer has to raise their retail price to maybe $1,300 or even $1,400 to keep their margin.
Okay.
Suddenly, the domestic manufacturer, still making it for $650, can keep their price at $1,200. Or maybe even nudge it up to $1,250 and pocket some extra profit.
And now they look like the better deal compared to the import.
Exactly. They're now $150 cheaper than the importing competition that just had to raise its price. So they start capturing those customers who were previously buying the import based purely on the lower price.
Which should lead to more sales volume for them.
Potentially significant volume increases and market share gains, yes.
It sounds like a strong position. But one question that always comes up, Do these domestic companies actually have the capacity to meet a sudden surge in demand? Or will they get overwhelmed, lead times get crazy long, and that erodes the advantage?
That's a very valid point, and it's often the constraint. The material does acknowledge this implicitly, but the companies that are highlighted are the ones likely best positioned, often because they already have substantial domestic operations.
So they can ramp up, maybe not infinitely, but enough to capture some of this shifting demand.
That seems to be the assessment. We're talking about companies like Lazy Boy.
Yeah.
Their ticker is LZB. They're well known for having a significant manufacturing footprint in the U.S. and Mexico.
Okay, LZB. Who else?
Also mentioned are Ethan Allen Interiors, that's ticker ETD, and Bassett Furniture, ticker BSET.
ETD and BSET, okay.
These are manufacturers with existing scale. It might get strained, sure, but they offer an immediate, reliable alternative supply right when importers are struggling with pricing and maybe even just fulfilling orders if they get caught in the transition.
That ability to deliver reliably, say in a few weeks when importers might be quoting months or have uncertain pricing, that's a huge competitive edge right now.
It really is. It becomes about more than just the sticker price. It's about availability and certainty, too.
Okay, let's shift to the second group of winners.
Yep.
U.S. cabinet makers. This seems even more dramatic because the duty is higher, right? That 50% levy on imported cabinets and vanities?
Yes, 50% is. Well, it's more than just a cost increase. It can function almost like a barrier.
Why is cabinetry different?
It's a bit different from upholstery. Cabinetry is often complex to produce. It's heavy, bulky, frequently customized or semi-customized for specific kitchen or bath dimensions. And it's tightly integrated into U.S. home building and remodeling standards and, frankly, aesthetic tastes.
Right, it's not quite as simple as just swapping out one sofa style for another.
Not at all. And the reason U.S. cabinet makers gain so much is that this huge duty drastically improves the value proposition of U.S.-made cabinets and also domestic private label supply, say, for big box retailers.
How so?
Imported cabinet lines, often from Asia, could previously undercut domestic makers pretty significantly, mainly due to lower labor costs. But a 50% tariff, that can completely erase or even reverse that cost advantage overnight.
And you mentioned it's hard to just move cabinet manufacturing.
Extremely. It requires massive investment in specialized machinery, complex supply chains for wood, hardware, finishes, plus huge factory spaces. You don't just pick up and move a cabinet factory easily. It takes years and significant capital.
So unlike maybe clothing or some electronics, a competitor can't just quickly pivot production to a non-tariff country like somewhere in South America.
It's much, much harder and slower for cabinets. That means the competitive advantage for existing domestic players is likely locked in for, well, at least the near to medium term.
Okay, so this immediately favors the established U.S. producers.
Yes, companies that already have the factories, the machinery, and crucially, the relationships with U.S. home builders, contractors, and big retailers.
Which companies are named to?
The material points to two key players deeply tied into the home construction and remodeling cycle. First is American Woodmark, ticker AMWD.
AMWD.
And the second is Masterbrand, ticker MBC.
MBC. Okay.
These companies are positioned to see, potentially, a substantial pickup in demand. Think about large builders or retailers who used to source a lot of cabinets from overseas. Now they're actively looking for domestic suppliers who are suddenly much more cost competitive, especially when you factor in reliability.
This isn't just about selling a few more cabinets at Home Depot, is it? It sounds like it could mean locking in larger, longer-term supply contracts.
That's potentially the bigger prize, yes. Replacing foreign competitors on major contracts that might last for years.
All right. There's one more group of winners mentioned. U.S. office and home seating manufacturers. Their situation seems a bit different.
It is slightly more nuanced, yeah. Many of these companies serve mixed markets. They sell to big corporate offices, but also increasingly to the home office or residential market.
And they already make a lot of stuff in the U.S.
That's key. They often have substantial U.S. manufacturing capabilities, especially for their core seating products, like ergonomic office chairs.
So how do they benefit? Is it just avoiding the tariffs?
That's part of it, but it's also about insulation and leverage.
Hmm.
First, many of their main products, especially the higher-end contract seating, might not fall directly under the specific imported upholstered furniture definition in the same way a mass-market sofa does. So their direct exposure might be less.
Okay, less direct hit.
Second, and maybe more importantly, their existing pricing power gets a boost. These brands, think Millerknoll or Steelcase, often command premium prices already based on design, ergonomics, quality, long-term warranties, and their relationships with corporate buyers.
Right.
Now, their competitors who do rely more on imports from maybe lower priced, but still competing, seating options are facing those rising costs.
So it makes the premium domestic brands look relatively better value, even if their price doesn't change.
Or it gives them room to increase their own prices modestly, improving their margins, without worrying so much about being undercut by a cheaper import, because that cheaper import just got significantly more expensive. The price floor for imports has been raised.
So they benefit both from their own cost stability and from the cost pressure on their import-reliant competitors.
Precisely. It widens that perceived value gap between the high-end domestic option and the potentially rising price of the import alternative.
Which companies are we talking about here?
The material highlights Millerknoll, ticker MLKN, and Steelcase, ticker SCS.
MLKN and SCS.
Got it. These are established players, leaders in the contract furniture world. Their business models were already somewhat less exposed to the most price-sensitive, import-heavy categories, and now that structure is turning into a real competitive advantage in the market.
That paints a really clear picture for the companies set up to win here. Their domestic focus, their supply chain independence, that's suddenly a huge asset.
It really is.
Okay, let's pivot now. We need to look at the other side of this equation. Which business models are most exposed? Who are the potential losers in this scenario?
Right, let's look at the flip side. Because for every winner created by these tariffs, there's likely a loser, especially among those heavily reliant on imports.
It sounds like a tough situation for businesses whose entire model was built on getting low-cost goods efficiently from overseas, especially Asia.
It is. And the first category facing, well, pretty immediate difficulties, according to the material, is the import-heavy online home retailers.
Online retailers, why them specifically?
They often rely very heavily on sourcing from China and Vietnam, particularly for the big volume categories like sofas, beds, other upholstered items, but also for what are called case goods.
Case goods, let's clarify that term again.
Sure. Case goods are basically the hard furniture items, the non-upholstered stuff. Think dressers, nightstands, dining tables, bookcases, TV stands, storage cabinets.
Things often made of wood or composites.
Exactly. And these are frequently sourced internationally because making them efficiently involves a lot of labor for woodworking, finishing, assembly, plus expensive machinery. So a 30% tariff on an imported dresser can be just as painful as on a sofa.
And the online model itself makes them vulnerable?
It does in this case. Many online furniture retailers built their businesses on aggressive pricing. They compete heavily on being the low-cost option, often using models that minimize expensive showroom and inventory costs.
Keeping costs down is paramount.
Absolutely. And that relentless focus on cost optimization now becomes their weakness. The tariffs hit them hard for two main reasons mentioned in the material.
Okay, what's the first?
First is the direct hit to gross margins. Or the alternative, having to impose price hikes that might just kill demand online, where comparison shopping is so easy.
Right, their margins are already maybe tight because of the low prices.
Exactly. Online retail economics can be super sensitive to even small cost increases. If a company operates on, say, a 35% gross margin, and suddenly their cost of goods goes up by 15% or 20% because they have to absorb tariffs, that margin can get crushed overnight. We're talking potentially catastrophic erosion for a business model that relies on volume.
Wow. Okay, so margin pressure is huge. What's the second reason?
Logistics and inventory. It's a potential nightmare.
Think about those large upholstered items, sofas, sectionals. They have long procurement lead times.
Meaning they ordered this stuff months ago.
Right. Orders placed maybe 3, 4, even 6 months ago, based on the old pre-tariff cost structure, are now arriving at U.S. ports after October 1st.
Which means the retailer has to pay that massive 30 or 50% tariff bill immediately, right when the goods land. It throws all their financial planning, their inventory valuation, their cash flow projections into chaos.
They budgeted for cost A, and now they have to pay cost B, which is significantly higher, on inventory they're already committed to.
Precisely. That immediate cash outlay and the hit to margins makes these online players seem particularly vulnerable.
Which companies are flagged here? What tickers should listeners be aware of in this context?
The material specifically names Wayfair, ticker W,
W.
and also Beyond, which is ticker BYOM.
BYON.
Both operate models that appear heavily exposed to imports from the affected regions and in the affected product categories. Their whole appeal often rests on being the value leader, and these tariffs directly challenge that.
Okay, moving on. The next group facing difficulties is interesting. Premium home retailers. You'd think maybe their customers are less price sensitive.
You might think that, and their customers are generally more affluent. But the issue isn't just about the end consumer price, it's about the retailer's own costs and operational structure.
How so? They still import a lot.
Yes, that's the challenge. Even though they sell high-end premium goods, many of these retailers still rely on a significant mix of imported upholstery and cabinets.
Why? Can they source high-end domestically?
Sometimes the specific styles, the craftsmanship, or specialized materials they want for their curated collections are sourced globally. Think Italian leather sofas, intricate European-style cabinetry. Global specialization exists at the high end, too.
So they face the same rising landed costs as the value retailers.
Fundamentally, yes. 30% on imported upholstery, 50% on imported cabinets. Those duties apply regardless of the final retail price point. But the material points out a specific operational problem for them.
What's that?
Their limited ability to quickly shift manufacturing back to the U.S., especially for these specialized, high-quality items.
It's harder to replicate that specific quality or style domestically on short notice.
Exactly. Setting up supply chains for, say, high-end European-influenced designs might require sourcing specific leathers, woods, hardware, training artisans, developing very particular finishing processes. That takes time. It can take years, not months.
So unlike a mass-market domestic manufacturer who might just ramp up an existing line, these premium retailers are kind of stuck.
They're in a bind, yeah. They can't easily or quickly pivot their supply chain for these specific imported items, so they face a tough choice in the short term.
Absorb the cost or raise prices.
Right. Absorb the significant cost increase, which hammers their profitability and might worry shareholders, or risk alienating their discerning high-net-worth customer base by imposing sudden large price increases.
Even wealthy customers might balk if a $5,000 sofa suddenly becomes $6,500.
They might. Or they might delay the purchase, wait and see. Luxury pricing often relies on a sense of stability and value, even at high price points. Volatility can hurt the brand perception.
Which companies fall into this category?
The material identifies Williams-Sonoma, ticker WSM,
WSM.
and RH, which used to be known as Restoration Hardware. Their ticker is RH.
RH. Okay.
Their reliance on imported goods in these specific tariff categories puts them in this difficult position, trying to balance margins against brand equity and customer expectations.
Okay, one last group of potential losers. The value and home retailers who have exposure to imported upholstery. These sound like the most price-sensitive of all.
They really are. These are companies operating often at the entry-level price points. Their entire business model is built around delivering acceptable quality at the absolute lowest possible price. High volume, low margins.
So any cost increase is a major threat.
A fundamental threat, yes. The tariffs directly challenge their core promise to the consumer. That 30% levy on an imported sofa that was already being sold near rock-bottom prices, say $399.
Yeah.
The retailer faces an almost impossible choice. If they raise the price to, say, $499 or $519 to cover the tariff, their core customer, who shops specifically in that sub-$400 bracket, might just walk away.
The demand is highly elastic at that level.
Extremely. That customer might just postpone buying a sofa altogether, or maybe they find a domestic alternative they wouldn't have considered before if the price gap narrows sufficiently.
And if the retailer tries to hold the price at $399 and just eat the tariff cost,
then that product likely becomes instantly unprofitable. They'd be selling it at a guaranteed loss, which is obviously not sustainable.
there's also a big risk of getting stuck with inventory, right? If they ordered goods expecting to sell them at $399, but now have to charge $500 and consumers refuse.
That inventory overhang is a huge concern highlighted in the material. Goods ordered months ago, based on pre-tariff costs and expected consumer prices, are arriving now. If shoppers balk at the new, higher prices needed to cover tariffs, the retailer might be forced into heavy markdowns.
Just to clear the stuff out.
Exactly. Liquidating that inventory at a loss just to free up cash and warehouse space. That puts serious pressure on the financials, especially for companies operating close to the bone already.
Which companies are mentioned here?
The material specifically points to Big Lots, ticker BIG,
BIG?
and also Lovesac, ticker LOVE.
LOVE. That's maybe surprising. They seem more innovative.
They are innovative in their design, the modularity, but the materials suggest their reliance on international sourcing for key components and frames for their upholstered Sactionals means that 30% duty could still be very damaging to their value proposition, especially relative to more traditional, potentially domestically sourced options.
Got it. So even innovation doesn't fully shield them if the core sourcing model is exposed.
That appears to be the assessment here.
Okay, this gives us a pretty comprehensive map of the potential winners and losers based on the tariff impact. Let's try to synthesize this in our final section.
Sounds good.
So, pulling this all together, what we've really seen is how a specific government policy, these new tariffs on imported furniture, translates almost immediately into shifts in competitive dynamics within this sector.
It really does. The policy acts like a filter, doesn't it?
Right.
It instantly seems to reward companies that have invested in North American manufacturing.
Mm.
Their structural insulation becomes a major advantage.
Right. And conversely, it directly challenges those retailers, both online and premium, whose basic business models rely heavily on those international supply lines, especially from Asia, for cabinets and upholstery.
The impact isn't uniform at all. That's maybe the most crucial point.
Yeah, so the key takeaway for you, the listener, is recognizing that these market adjustments aren't hitting the whole furniture sector evenly. It's not one size fits all.
Not at all. Predicting the outcome or understanding the pressure points really depends on digging into those two key variables we discussed.
Which are?
First, the source of the supply chain. Is it primarily domestic or heavily reliant on imports from the regions being tariffed?
Okay, source matters most. And second,
Second is the type of product. Does it fall under that really high 50% duty on cabinets and vanities? Or the still significant 30% duty on upholstered goods? Or is it something else entirely?
understanding those two things, where it's made and what it is, seems crucial for assessing how any particular company might fare in this new environment.
It provides a much clearer lens, yes.
All right, so here's a final thought to leave you with, building on what we've discussed. The material clearly shows these import-heavy retailers are facing serious margin pressure, maybe even inventory crises.
Right.
The obvious reaction is trying to raise prices, but beyond that, what else could they do? How might these more vulnerable companies strategically adjust?
That's the key question for them going forward, isn't it? Instead of just passing costs on, could they pivot their product mix more aggressively?
Meaning?
Focusing more on categories that aren't subject to these specific tariffs, or maybe rapidly trying to develop supply chains in countries not targeted by these duties, maybe exploring options more seriously in Central or South America or Eastern Europe.
So becoming more operationally agile, trying to diversify their sourcing away from the tariff zones as a survival strategy.
Exactly. That kind of strategic agility or lack thereof might really determine their long-term ability to navigate this, rather than just relying on price hikes that consumers might reject. Something to watch.
Definitely something to watch. Okay, before we wrap up, the necessary disclaimer.
Of course.
Please remember that the information and perspectives discussed on this program are purely the opinion of the author of the material presented. This analysis should not be construed as financial advice or as a recommendation to buy or sell any of the securities or companies mentioned.
That includes those with the tickers we discussed. LZBETD, BSET, AMWD, MBC, MLKN, SCSW, BYON, WSM, RHBIG, and LOVE.
Always do your own research or consult with a qualified financial professional before making any investment decision.
Absolutely.